Hey tech lovers, buckle up because today's spotlight is on a paperless pioneer, DocuSign, which has been having quite a roller coaster ride in the stock market today. Anyone wants to decipher those electronic squiggles? No? Just me? All right, we're sticking to DocuSign. So DocuSign has been making headlines today, but not for the reason you might expect. They recently posted their first quarter financial results, and while the initial numbers might make you throw confetti, at least until they hit the floor, that celebration was short-lived. The DocuSign earnings report revealed some exciting stats. Better than expected earnings per share of 90, sprinting ahead of the 81 predictions. Revenues also climbed up to $763.7 million, beating the street's expectation of approximately $748.13 million. Subscribers and service split, not forgotten. Subscription revenue reached $746.2 million, showing an 8% increase, while the less glamorous cousin, professional services, ticked up 4% to $17.5 million. But wait, here's the plot twist that transformed ticker symbols into alarm bells. Despite breaking and exceeding the earnings guesstimate, shares plummeted by around 19% today. It's like winning a baking contest, but dropping the cake before the judges get a bite. Investors were disconcerted by less than explosive billings growth, just a 4% climb. And more importantly, the free cash flow decided to go on a mini diet, shrinking slightly to $227.8 million from last year's $232.1 million. So who turned out the optimism lights? Warnings of decelerating revenue and billing growth painted a somber picture with muted fiscal guidance. DocuSign predicts revenue for fiscal 2026 to be around $3.15 billion to $3.16 billion. While it's an increase, it ain't the high-speed train investors were hoping to catch. Slow growth and murmurs of an anticipated momentum fade added raindrops to investors' hopeful parades. Adding a spark, or perhaps a question mark, DocuSign announced a $1 billion share repurchase plan. Yay for buybacks, but the excitement deflated somewhat, considering it's bound to just counteract increased share-based compensation. In short, Wall Street snubbed the results and focused keener eyes on future growth challenges. Competition looms large from Adobe and Microsoft as DocuSign wrestles to not just shore up its e-sign fortress, but also expand it into new territories. Their strategic direction under CEO Allan Thygesen aims at shaking things up, but investors eye the speed at which DocuSign's roadmap promises growth with skepticism. Shares took a dive, trading at about 18% lower than expected, around $75.81, after the analysts trimmed their forecasts. With DocuSign aiming to push boundaries on digital agreements, the question on everyone's lips is how quickly growth will follow to truly reflect its pioneering reputation. So DocuSign fans and investors seem to be biting their nails, waiting to see if the company can successfully shift gears from immediate satisfaction to long-term growth. Remember, folks, in tech, just like in career moves, past performance doesn't always guarantee future success. DocuSign still stands strong as a market leader. It just has a bit of a rocky road to pave before the stock might pop that champagne again. Stay tuned. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.